Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He notes copper was very hot and uranium has bounced back. Ross takes a look at gold, crude, the U.S. and Canadian dollars, and Bitcoin. Veteran trader Victor Adair checks in from Vancouver Island to give us his view on copper, gold, silver, crude, and natural gas. He tells us what he believes could hold up the development and deployment of AI. Editor of Rick's Picks, Rick Ackerman, tells us he believes there could be some cloak and dagger intrigue behind the recent fall in Bitcoin. He tells us President Trump has some good ideas to fire up the American economy, but the execution of those plans has some flaws. When it comes to the stock markets, Rick says you best have one foot on the fire escape. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always good to be with you, Jim. And it's been an interesting stretch here. We've gone through the U.S. Thanksgiving, which historically is where you see some buoyancy. And this one started a few days early and has carried through with a little bit of upside, but not the momentum it had coming off the bottom. It really now becomes important to watch this stretch, the 10 days or so after U.S. Thanksgiving. It's important you look at sort of a litmus test to see how much strength there is. Right now, the S&P is sitting about 68.90, and we are looking at resistance up around 70.10. And if it can't get through that in this next week or so now, then the implication will be that there isn't the standard momentum going into the end of the year. And if we look back since the year 2000, only half of the years have actually had a good run into the year end. The other half of them settle right back down. The ones that do manage to show strength right now, and that would be, say, a close above 70.10 on the S&P cash, then you can look at that strength to carry you right through into mid to late January, sometimes longer than that, but that mid to late January would become a reasonable window to look at. Now, on the short-term basis, the volatility index, VIX, has been slowly sliding away to the point where we've got a signal in VIX, and we haven't had a volatility index reading of any significance since back in June and April and June. The April one produced a buy signal for the market. Then in June, we had a couple of minor signals that were for sells, and we saw pullbacks to the 20-day moving average each time. Now, this is the first signal since June, and the likelihood is that support would be found around the 20-day moving average on the S&P. That would be about the midpoint of the trading range we've had since October. So if we don't gain upside momentum here, then that's where the support is. And there have been 80 of these VIX signals that we look at since back in 2000, and 30 of them came back to that 20 moving average. 9 of them didn't have a correction at all. So, we'll keep a pretty close eye on this, but we know where the initial support is.
What's going on with gold?
Gold, the precious metals have had just a quiet stretch with some upside bias to it. The gold's sitting around 4,200 right now. we've been looking at the 42.10 level to see if it could pop through there. That would be through the closing highs that we had in mid-November. It's gotten up there, but it doesn't have the big momentum push to pop it through. So the trend is up. Support has been well established around 4,000. So we'll see how that one goes. Silver continues to have been the strongest precious metal in the near term. That was all-time highs at the beginning of the week. A small pause, and we're back at all-time highs again. The big cycle we're looking at, the 5-year cycle, points towards a high during the Q1 or Q2 in next year. So there's plenty of time for this thing to run on the upside. The channels we look at on the weekly and monthly charts show that the reasonable targets are at 75 and then at 125. So the big cup and handle pattern that we've had going on here for a number of years with now this breakout has got potential, clearly, to provide that type of action on the upside. So for now, support is probably back at the old highs that we had in October, and that's what we should be looking at. And over in thinking of metals, one of the strongest one out here of late has been copper. That's breaking out of a nice base through the 520 range. We're up to 5 through 540 as of this week. And if we take a look at the miners in that section, they've been having a really nice run, and I wouldn't be at all surprised to see that this continues on for quite a while.
Anything happening with crude?
Crude has, had enough news to give it a bit of a spark on the upside. We're trading through $60, and that's testing the resistance area that it has had in place here for the last couple of months. We're at the 50-day moving average. That has been a pretty solid resistance line, so we'll use that as our point of measurement to see just how strong this market is and whether it's capable of doing much more on the upside. Seasonal we were hoping for would have been for a deeper break and produce some good oversold signals. There's been nothing of any significance in here. So, we'll just bide our time as far as that's concerned. In the complex, natural gas has been having a really nice move. We've got the April contract now up through the 440 range. That's been a pretty significant run, probably getting ahead of itself right now, and you could be looking for a setback in that one. And the natural gas stocks have been, the Canadian version at least, have been doing famously well. So look for a pause on that uptrend, and you probably want to buy the dip.
What's going on with the U.S. and Canadian dollars?
U.S. dollar has been slowly sliding away since getting up to its resistance levels up around the 100.25 level. We're at 99 and change right now. This is, I think, a level that we need to see some support at. There is that big double bottom from July through October, and with that, there's enough potential in this thing for it to gain some upside momentum. But we've got to turn here from 99 and getting back through, I would say. By the time if we get back to 100, we're probably on our way to higher levels up around 103 to 104. The interesting item here has been the Canadian dollar this week. It finally managed to really pop to the upside. It became oversold on the weekly charts back here about 3 weeks ago, double bottomed at 71, and now we're at 72.25. That breaks out through the resistance lines and also is taking out the October high. And that's important because it's outpacing what we're seeing in the oil market and in the CRB index, the Commodity Research Bureau index. So for now, that one, the dollar's got strength. And once you turn from levels like this, you want to let the rally run its course. Would be looking at the weekly relative strength index. Maybe if it can get up around 70, that would be into a potential area for the top. But that's going to take a bit of time to evolve. So I wouldn't be in rush there. The other thing to be on the lookout for would be a divergence against the crude oil and CRB. That would take time to develop. That would be with the dollar pausing in this uptrend, with the other two items continuing higher. So for now, the Canadian dollar is outpacing CRB and crude. So it's free to run on the upside. I guess one of the big items here a week or so ago was the uraniums. They put in just a really nice bottom, some good oversold readings that we got back in the third week of November. And then a pretty good bounce. Most of them retraced a good 60% of the decline that they had from the October high. Yesterday, a bit of a momentum move on the upside. There was an interview done with Jensen Huang, the president of NVIDIA, talking about the need for energy and all the data sources, data banks, and that SRMs would really be the wave of the future. Well, that created a bit of hype, but in reality, these things take years to be built and developed. So it's positive for the long term in uranium, but the spurts like we saw yesterday are probably due to have pullbacks.
Now, perhaps what's caught a lot of attention over the past couple of weeks is Bitcoin's dive.
Yes, this has been a fairly dramatic one without it stating the obvious. We came from 125 down to 83,000, that is, and got some good exhaustion readings right at the bottom. And typically what will happen from that is that you'll have a corrective rally that will take upwards of a month, and this one has now taken 2.5 weeks. And then you would be looking for some pretty good resistance, I think probably in the 94 to 96,000 range. And from there, probably set back and test the support levels again. It's been a great trade off the bottom, but the easy money, I think, on that bounce is behind us. The next good trade is probably a short sale when we get up to the 20-day Bollinger Band, and that one isn't that far above us. We've settled down a bit here today at 89,000. So, if you got a good rally in the next week or so, could be looking at a selling opportunity, as I say, as it approaches the 96,000 range.
Ross, thank you so much for being on This Week in Money.
Always a pleasure, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Victor Adair, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in British Columbia, but still very active in the markets. His website, victoradair.ca. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Good to be back with you, Jim. Thank you.
Before we discuss individual markets, what do you see as the big stories that will affect the markets through the year end and into next year?
Oh, boy. Yeah, exactly.
That's a loaded one.
Well, probably a continuation of some of the things we've had. The AI story, which has been very captivating for sure. I think the run it hot thing that we hear about, where we're going to get stimulative fiscal and stimulative monetary policies just to, the best way to get out of debt is to spend more money, that kind of thing. And that's not just in the United States. I mean, that's Germany, that's Japan, that's Canada, so that's kind of something going to really be on our radar. People know about the debasement trade. My definition of inflation is that if there's too much money in circulation, that reduces the purchasing power of the currency, and, that's inflation. So I think we're going to see more of that. Certainly geopolitical stress, we got any number of places where that could pop up or quiet down. I mean, the Israeli-Mideast conflict quieted down. It seems recently as though there's some hope that the conflict in Ukraine would quiet down. But and then, of course, the big one is what's the relationship between the United States and China going to look like? Yeah, I think there's this, what did I say the other day? If you don't feel overwhelmed, you're clearly not paying attention. So, I couldn't give you a short answer to that question.
Most of the leading global stock markets corrected in November, but now it looks like the Santa Claus rally is underway. What are your thoughts on that? Should we be jingling our bells?
Well, it certainly looks that way. I mean, I guess at the lows in mid to late November, the NASDAQ was down about 9% from the all-time highs it had made, end of October, early November. S&P was down less than that. But, yeah, and all around the world, as you say, the leading indices, they're all looking over their shoulder at each other. So with the American markets down, so is everything. To some degree, that the Toronto market just kind of went sideways, and now it's gone up to new all-time highs again. But, yeah, the Santa Claus rally. I mean, one of the reasons for the Santa Claus rally is that historically, the month of the year where there's the most new money from retail customers comes into the market is December. The last week of November with the Thanksgiving Day holiday in the United States is almost always an up week. So, yeah, the Santa Claus rally was kind of in the historical cards, and I don't know, I think we had 5 consecutive up days as we started December from late November, or, like we're up 8 of the last 9 days or something like that. So, yeah, when the market, I've described it this way, as much as there may be a reason for the market to have a correction, there is a very powerful buy-the-dip mentality in this market. You have a hard break on whatever time frame you want to talk about, and it's followed up by a rally to new highs. So I think even the people who are the most doom scrolling, and there's all kinds of reasons to expect why the stock market is goofily overvalued and all that, and I understand it, believe me. But if you're trading these markets for the objective of making money rather than proving to the world that you were right all along, you got to respect the fact that there is a very powerful buy the dip aspect to the stock markets.
Silver's attracted significant media attention as it trades at record highs. What's happening in that market, and is it having an impact on gold?
Yeah, silver's been, I was discussing that with Rob Levy from Border Gold, and I called silver the wild child. And compared to gold, which looks serene, alongside silver. Yeah, silver's been the wild child. Somewhat similar to gold in that there seems to have been a substantial increase in people who want to own physical silver. Now, we understood in the gold market the big buyer that wanted the physical gold were the central banks. I'm not sure that it's the central banks. In fact, I kind of expect it's not, but never say never. I think it is retail at one level, and then other people who are just seeing silver as a metal that's going to be demanded, certainly in the energy space and the computer space as we go forward. The distribution of electricity and on. But let's say a subset of the AI story, and we had a great run. I mean, I was trading silver when it hit $50 an ounce for the first time in 1980. I'd been trading it I remember trading it at $3 an ounce back in the late 70s. It hit $50 an ounce again. I think it was that in 2011, and we just ripped through that. We almost hit $60 this week, and I wouldn't be surprised we've got higher prices as we go into the latter part of the year. The technical guys, not the technical guys, but the people that look at it from a fundamental side would say that there has been a deficit in the amount of silver produced in the past few years, and that's a structural deficit. A good part, certainly over half of the silver that's mined every year is mined as a byproduct of going after base metals, copper, zinc, that sort of thing, lead. To expect that there's going to be a bunch of new exclusively silver mines open up seems unlikely. So the physical supply of silver for people who want silver, they don't want to just take advantage of the price of silver changing. They want some physical silver that gives that structural deficit, and that seems to be the scare. Now, there are a lot of stories out there about manipulation and this and that. I understand that. It may or may not be true, but if you're trading silver from the short side, you're going to need to be prepared for some surprises. I remember talking about 1980. Over a weekend, the COMEX, the major New York metals future market, changed the rules. And changed the rules basically in favor, no doubt, of the members of the exchange. And the rule was that people that were trading silver could not put on a new position unless they were producers. And the COMEX argued that they were trying to protect the integrity of the exchange and so on and so on and so on. But what that meant is on the Monday morning we came to work, the price of silver had dropped from $50 an ounce to $37 an ounce because people could clearly see that without new buying, if there were selling, the price was going to drop. So I wouldn't be surprised we see a change in the rules around trading silver, whether it's in London or Shanghai or in New York. And it's possible that it'll be set up so that people can profit from a change in the price of silver, but they won't actually get a bar of silver. So if you're looking for that, you'll have to get it elsewhere. Now, that's just me thinking about it. I'm not saying that's going to happen, but there's been a lot of action in silver, and it all revolves around, it seems like there is a shortage of physical silver, not enough physical silver available for the people who want it.
The Fed meets this coming week amid expectations it will cut short-term interest rates again. What do you see happening?
Yeah, the Fed is pretty much telegraphed that they're going to cut short rates this time. The market's pricing, an 80 to a 90% chance that they will do that. The key, again, will be if it's a dovish cut or a hawkish cut. So a hawkish cut would mean they say, okay, we're going to cut rates, but that's it. Okay, we're not going to do it again, or not for a while. And where a dovish cut would be, okay, we've cut rates, and we can see we're probably going to have to cut rates again sometime soon, just to give you that description. Clearly, the bond market doesn't like what's going on here with short rates. We've seen the yield curve change dramatically over the past year, where a year ago short rates were higher than bond yields, which is unusual, and now we're back to a more usual situation where short rates are lower than long rates, and the long end of the market, the yields, I should say, at the long end of the market are rising. And nowhere are they rising more dramatically than in Japan. We have I think the 30-year and out in Japan are at all-time record high yields. The Bank of Japan for the past several years kept a lid on the bond market. They called it yield curve control to keep the yields from going higher, and they backed away. The Bank of Japan has been making incremental changes to short rates increases. Now, they're, I think right now at about 0.5%, and the thought is they may go to may raise rates by 0.25% at their meeting coming up this month. I can see kind of a teeter-totter, I call it, for bonds. On the one hand, if we are in a run-it-hot kind of environment where the leading governments of the world, are spending more money than they're taking in, then they got to borrow, and some of that borrowing will be done at the long end, some at the short end. But that is going to put pressure on yields. Let's call it the bond vigilantes. Just say, no, I need to be paid a premium to buy this long-term paper. And on the other side, we get indications that the American economy may be slowing. We're certainly seeing consumer confidence is down. It looks like employment is not growing, or certainly not growing in a strong fashion. It's difficult to say these days with a lot of the data missing. But anecdotally, we can see that there's a bifurcation in the consumer market. The top 10% of people in terms of wealth are doing 50% or more of consumer consumption. They account for more than 50% of consumer spending. The poorer people are going more and more to dollar stores and that kind of thing. We can see the traffic, and the sentiment is pretty negative. So that might be an environment where the bond market would catch a bid. It kind of looks like, or some people could paint a picture, that we're going to go into a recession. So, there's another one there too as well. If there was to be a recession, typically that would see stock market prices or prices of stock indices go down, and in that kind of an environment, there might be a bid for bonds. So the teeter-totter I'm talking about, on the one hand, the run-it-hot inflationary, what do they call it, the debasement trade aspect means that bond yields go higher. A slowdown in the economy and that sort of thing means bond yields go lower. I'm kind of predisposed to seeing bond yields go higher. That's kind of if I had to vote one way or the other, but as a trader, I get to change my mind every day.
Currency markets have been relatively quiet, although I see the Canuck buck close this week at 3-month highs. Is the U.S. dollar still the most important currency in the world?
Absolutely. Yes. Yeah, the U.S. dollar is the most important currency. It's when you look at the settlements and trade and that sort of thing, it is by far and away the leading currency in the world, and I don't see that changing. There's been different movements to what they call de-dollarization and that sort of thing. Fundamentally, where are you going to go? The euro. At one point in time, people thought maybe the euro would at least be a rival for the U.S. dollar, not necessarily take its place, but that seems less likely. And I would say, just as an opinionated person, that I couldn't justify, like on a fiduciary basis, I couldn't justify making long-term investments in Europe in lieu of putting money into the United States. I've said on your show here many times over the years, one of my favorite sayings is that capital comes to America for safety and opportunity, and I think that is still very real. Safety, especially when things are stressful, man, the U.S. dollar goes bid. And in terms of opportunity, well, they don't have any AI in Europe. It is in America. Certainly they've got AI in China, and China may be one of the adversaries for America in terms of dominance in that aspect. But, if I'm going to sell something to somebody and they're going to pay me, I'm going to want U.S. dollars way more than I'm going to want Chinese RMB. The Canadian dollar, Canada's been up here the last, say, half a dozen sessions or so, but one of the ways I look at news, and the news was that we've gained, I don't know, Stats Canada, hard to know if they're really on the ball, but 120,000 jobs or something in the last 3 months, which certainly was much more than expected. The GDP is stronger than expected. Again, counting noses, hard to say if they get it all right. But anyway, that's the news that's out there, and that news has arrived in an environment where speculators were by far and away net short of the Canadian dollar, which when bullish news comes out and you're short, and especially as the market starts to rise a bit, some of those shorts are going to say, okay, let's cover our position, and they turn buyers, and that will have accounted for some part of the rise we've seen in the Canadian dollar recently. Jimmy, just thinking about it, when we're talking about silver, I meant to say something about copper, if I could just kind of jump back to that. Copper traded at all-time highs this week, I guess, in London. And it would have also traded at all-time highs in New York, except when you go back to July, early in July, the copper market spiked higher. I'm going to say it went up to about $5.50 or so. And the cause for the spike was that the market thought that the Trump administration was going to put tariffs on any copper coming into the United States. And this, I'm going to say, was kind of a fault of the Trump administration for not being more clear. Trump says, we got a deal done or something. And people, well, are there any details to this, sir, that we ought to know? Well, then later in the month, it came out that, no, they were not going to put tariffs on everything that was made out of copper. I should say that if you were bringing like raw copper into the United States from refineries outside of the country, that was going to come in tariff-free. If you're bringing in some specialty stuff that was made out of copper, it was going to have a tariff on. Whatever. We had the price jump and then fall back later in July in the COMEX market, accounting for that spike high. I see copper, and this is a story that's been around for 5 years, as the electrification of everything is going to boost the demand for copper, and it's going to be something like what's happening with silver. There's just not enough physical copper going around to meet everybody's demands. And by the way, here's another sidebar. China demands about 55% of the total global demand for copper. So one of the things that I've thought for a few years is that China, because of the collapse in the real estate market and so on, their domestic market is struggling, the GDP domestically. They're trying to make up for it by being a super exporter. But if the domestic economy in China weakened, you might see a significant drop in the demand for copper, and then there'd be like more than enough copper to go around. Now, that's speaking very loosely and off the cuff and all that, but just these are the big pictures on copper. If one of the stories about the negativity on copper was that nobody's found a major mine in a long time, and even if you found one, it takes years, and years to bring it into production. I'm going to take the under on that. And one of the old sayings in the commodity markets are the best cure for high prices are high prices. Because when prices of stuff is high, there are all going to be people that are going to innovate. They're going to do this or that. They're going to do substitution, whatever. But one of the things I would be willing to forecast is I could see there'd be a terrific increase in Canada for people that are looking for a viable copper mine, and it might just be reopening one that's been closed for some time, or you take a different kind of technology to look in the ground to find the copper, take a different kind of technology to get it out of the ground, that sort of thing. My parallel on that would be the oil industry. I've subscribed to Doomberg since he started writing his letter, and I paid attention to him before that. And one of the things he says about oil is there is no shortage of oil. And when you look at the price of oil, and when I go to Joseph Schachter's conference every year and just get overwhelmed at the technological advances that we've seen in the hydrocarbon sector, I can see something similar happening in the mining sector. So you might be able to say a couple of years from now, there is no shortage of copper in the world. The new technology that we have, we're finding all kinds of it, and so on and so on and so on. So I guess I'm getting a bit wound up on it, but I'm just saying I think copper is just a very, very interesting play right now with, electric vehicles, artificial intelligence, and everything else with the demand for electrification. I still think, and another sidebar here is I still think that the bogey or the tripwire for the rolling out of the AI industry is going to be whether or not they've got enough electricity and what their demand is going to do to prices of electricity for other people and so on. So the copper is going to be a great story to pay attention to here, and I would imagine there'd be some really wild price swings in copper going forward.
Any thoughts on the king daddy of cryptocurrency, Bitcoin? Bitcoin
traded to all-time highs, October or so, and then I think we had a correction of about 40%. Now, in Bitcoin's history, and, forgive me, I do not trade it. Mm-hmm. I certainly watch it. It's I talk about the S&P as being my go-to barometer for risk appetite in the market, but I definitely also look to Bitcoin for the same thing. I think the folks that are trading Bitcoin are probably more willing to use leverage or use greater amounts of leverage than other markets, so I'm interested in that. Bitcoin's had that 40% correction. It's had them before. We'll see where it goes from here, but if I was just looking at it chart-wise, I'd be more likely to short it than to be a buyer. And I think there's been so much fluff come out into that crypto market where people have put money into different things that, aren't as have fallen in price, and like fluff and stuff like that will get spiked up on some enthusiasm, and then when the enthusiasm dies down, it's the first guy out the door is the only guy who lives. So yeah, I'm not sure I'm exactly answering your question on Bitcoin.
Well, it's something that has nothing to back it. And, we're one Carrington event, one solar flare away from it being totally wiped out around the planet.
Yeah, I hear that, and I did say I don't trade it. I've traded financial markets for 50 years. I find I've got more than enough to do trading the markets that I do trade. And when I saw some stories in the early days about people had some Bitcoin and then suddenly it disappeared or something like that, I thought, I can't trade a market like that. I don't need to. But at the same time, I'm not going to badmouth it because I've seen some pretty smart people, some very smart people talk about it, and they think it's, the next great thing. So it's just, I don't want to comment on any market that I don't know anything about. If you want to ask me what the price of pigs is in Manitoba, I'd just have to say, I don't know.
Well, Warren Buffett said he made all his money only investing in things he understands.
Yeah, and good for him. And I think that's a good way to go. But when I look at, and I've met a number of very successful call them traders or investors in my life, and certainly read about more. The one thing that they have in common, and maybe the only thing they have in common, is that they are all they've all found a way to participate in the market that works for them, and it probably wouldn't work for anybody else in that group.
WTI crude oil was around $120 back in 2022 following the Russian invasion of Ukraine. Now it's around $60. Do you see it rising like other commodities, and why is natural gas surging?
The short story on crude is just the old story of supply demand. They've tried to put sanctions. They put sanctions on Russia. Well-meaning, I guess. Let's stop the Russians by crippling their economy, and they'll stop beating up on Ukraine. I get it, except the sanctions clearly don't work. The oil finds its way into the market. Oil has been incredibly fungible the whole time. It's been out there. And we could go back in history on that, let's say over the last 50 years. There's more oil being produced. I said something about Bloomberg a few minutes ago where he's talking about, the technology they're able to get. If there's a pool of hydrocarbons, 5,000 feet under the ground, if 20 years ago the technology would allow them to get 10 or 20% out of that, up out of the ground, well then, by rough example, these days they can get 40% of that. The technology is improving, and that's one of the things that if you look at crude oil, I remember crude oil, it wasn't $2, but, we're trading at $20 and $30. If you look at the inflation-adjusted price of crude now, is probably as cheap as it's been at any time over the past 40 or 50 years, and I think that's a direct result of the improvements in technology. I see right now the average price of gasoline in the United States is below $3 a U.S. gallon. Well, that's the lowest it's been in the last, half a dozen years. That's where I think, outside of, let's say, some surpluses around COVID. The price got up to $120, as you say, because of the Russian invasion of Ukraine, and it looked like there was going to be a shortage and political stress, and where next are we going to have a problem? And it's come back down the way it has. We had some spikes during the conflict in the Middle East where there was Hezbollah or the other people that Israel was fighting with, the Iranians themselves, but the risk premium just didn't stay in the market. And I think the positive story for crude is going to be the emerging market. I was looking at India the other day, and I was thinking, look at this. Their GDP is about 8%. Their currency has fallen to an all-time low against the U.S. dollar. Their short-term interest rates, I think, are about 5.5% right now, and the stock market has gone up this year about as much as the American market. And this is an economy of at least as many people as there are in China, and they are on a planned growth of just, pedal to the metal, and they're going to want to demand more energy. So, and there'll be other places outside of the developed markets like India, but it's the most dramatic story, particularly the size of the market. And I think that's the sort of thing where you look and see, a good bid coming for oil. Another aspect of oil I look at, and I see that the share prices of the oil companies are doing way better than the price of crude. And I think, wonder why that is. It's not like the price is so high that they've got a huge margin between their cost of production and what they can sell for. Or maybe it's just the people that own the shares in the oil companies have got a longer-term view, and they say, this market is going to be a booming market over the next few years. To come to your natural gas, I think is up about 20% just in the last week. We're at about a 3-year high. This is NYMEX, New York traded natural gas on the futures market. Certainly the short term here is there is the polar vortex or whatever that's causing cold weather in the eastern part of the country. The reserve levels, storage levels in Europe are well below where they were this time a year ago. There are more and more demand for LNG going from America to Europe. So, and I mean, I just basically love the natural gas story in terms of it is going to be the fuel of choice for creating electricity, heating homes, and whatever else. So it's hot lately. The price is anyway, and we'll see where it goes from here.
Victor, before we wrap up, do you have any predictions or advice for our listeners as we head into 2026?
I think I probably made a couple of predictions there, and I don't really mean to. But I think it's kind of a joke this time of the year when people feel obliged to. Oh, we've had a committee meeting and we've decided that our view is that 12 months from now the price of this will be that. That's not where I think. I mean, I can imagine things like that, but if I'm actually hitting the buy button or sell button on my computer, it's got to be something more real than those things that are going to drive me to do that. However, I think there's too much leverage in the world, okay? It has been 3 years since we had any kind of a decent correction in the stock market, and in 2022, the S&P from top to bottom fell about 25%, and that got a few people's attention. We had, I guess, about a 10% dip back on the Liberation Day fiasco in April of this year. But, more and more, as I talked, earlier, there's just this buy the dip mentality, and it is strong. And there's all this passive money that's coming into the market. And there's capital that's flowing into America. Trump wants to brag about Japan's going to put up $500 billion. And the Saudis, they're in for $1 trillion, and there's going to be all this run it hot and all that kind of thing. So people can get enthusiastic. When I enter a market, I mean, I'll have my reasons for it, but the question I need to have answered before I write a buy ticket, as it were, is where am I going to know I'm wrong? What will have to happen, and I'm going to say, this is not such a good idea. So my shorthand for that is I make money from my trading because I am really good, and I'm bragging, I guess, but this is the truth. I'm just really good at managing my risks, and that's way more important to me than pretending I've got a crystal ball that's better than anybody else's.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure to talk with you. Thank you for having me on.
My guest has been Victor Adair. His website, victoradair.ca. Coming up, Rick Ackerman, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website, rickackerman.com. He's speaking to us from...
It looks like Vancouver out there. I'm on the eastern shore of Virginia Beach, just visiting with a college buddy, and I'm kind of enjoying winter. So I don't get much of it down in Florida, so I like the cold weather.
So do you have fog and rain right now?
Yeah, it's pretty overcast. I guess low clouds, and no evidence that the sun even exists.
Yeah, you got Vancouver down. That's exactly what it is right now.
But whereas we'll maybe be sunny and mild tomorrow, and Vancouver will still be socked in for until May.
Rick, before we get rolling here with the interview, can you tell us a bit about Rick's Picks?
We've been having a bloody field day. Someone should come in the the chat room. This morning, my guys used a target in the QQQ, otherwise known as the cubes, kind of tracks the NASDAQ as a place to get short, and we're only off by, I think it was 0.03 of a percentage point at the top, and the Q625 puts have already sextupled in value, or very nearly. In about an hour, they went from a low of 38 cents to $2.16, and we've got some very good guys tracking the silver markets, and the chat room is a good place for real-time information. So a lot of my subscribers were able to pile into Capitan, which is a silver mining company, and a couple others right before they began these huge moves, which, as far as we can surmise, that has plenty of room to run. So we're right on top of the bullion move and just having a feast.
Silver hit new all-time highs this week. We're hearing predictions of $125, even $200 silver. What are your thoughts on silver?
Well, it's amazing how an opportunity can stare you in the face for years and you're just not believing it. But I know a friend of mine who was in the commercial real estate business. He had the good sense and good timing to sell the top in San Francisco and a couple other places where he owned office buildings. But he's been buying 1,000-ounce bars of silver for as long as I can remember. And quite some time ago, this would have been a couple of years ago, he was saying that it was so hard to get your hands on silver, physical silver. The deliveries that used to take 3 to 5 days were now taking a couple of weeks. So I queried him the other day, what are you doing with your silver? Are you blowing any of it out here? You've got such a huge move. And he says he's not touching it. He hasn't sold a single bar. Not only that, he acquired another 1,000-ounce bar for this past month, and he said that the dealer that he gets his silver from is now saying the wait time is I think it was 3 months for delivery of a 1,000-ounce bar. So it's insane. The mismatch between physical supply and demand is it's stretched about as far as it can go. And of course you can see indications, evidence of official concern, because we had that fraudulent shutdown of the exchanges a week or so ago, ostensibly because of some quote-unquote cooling problem with the servers. But of course, we know the exchanges simply shut down because there was a huge influx of orders to buy silver that was beyond the delivery capabilities of COMEX. So the official story got kind of reshaped there, but the fact remains that the demand for physical, not just silver, but gold is outstripping supply.
Mark Zuckerberg's Meta platform is looking to put more focus on artificial intelligence. Is this a good indicator for the AI bubble?
What a jackass. He rebrands the company, Facebook, to Meta, and he basically goes all in on virtual reality. And I think his losses right now in the division which has developed Meta uses, none of which are hugely profitable or even profitable at all, but they've absorbed losses, I think, of somewhere in the neighborhood of $70 billion, which even for Facebook is not chump change. And so I'm not sure what he's going to do with the Metaverse brand, but he's cut back on R&D money to that division, and he's trying to sort of sidestep it with a little bit of wordplay, and he's talking about sale of the Ray-Ban glasses and a couple of other optics, but he's going to have a tough time backstepping his way out of the metaverse that he thought was going to be the way we lived. And I think even with the Ray-Ban glasses, that's probably further than most people want to go into the Meta universe. But I think it's really just it's a warm-up for what's going to come in AI, because the similarities are hard to miss as far as the huge amounts of money that have been spent on research and development for products that, well, nobody knows what they're going to do, much less how they're going to make money with them. And I keep thinking that the lowball figures, you'll read someone like Goldman's quote-unquote expert says that between now and 2028, there's going to be whatever it was, $700 billion worth of investment in AI, but that's just a beginning, like coming at you number from Sam Altman these days. Every player in the game is talking $1 trillion figures, and of course Musk is already in at that level, or he's getting there, and talking about building his own fab plants to make chips for all the robots we're going to have. So I just don't see it. I don't see where the payoff is going to be big enough to reimburse all these to make these trillions that are going to be sunk into AI, and a large piece of which in circular fashion has already been put there. So the question is, well, where's the money? Where are the profits going to come from, especially if AI robots put everyone out of work? So just I do think, though, that Facebook is the handwriting on the wall for what's going to happen with AI.
Bitcoin, correction or bear market?
Well, it's interesting, when Bitcoin gets slammed from 120K plus down to 80,000, all the bozos who write this up for Bloomberg and the Wall Street Journal, their expert columnists say, well, it was just a heated market, and this is the result of speculative excess. Well, it's not. It's the result of somebody selling a huge amount of Bitcoin, and none of these guys has ventured forth with an answer, because they're all lazy screwheads who got their education at journalism schools from professors who've never worked for newspapers. So they never bothered to ask the questions. All they give us is a lot of weather stories. And having been a newspaper reporter and editor myself, I know the reason why weather stories have assumed such great importance in the headlines. It's simply because they write themselves. A lazy hack that's doing a weather story, and I've done a few myself, or I did a few in my time, you hardly have to do any research. You just call the weatherman and you quote him. So with Bitcoin, same thing. It comes down so hard, and they're all trying to pass off the story about, well, this is just what happens when you get too much speculative froth. But I happen to like one theory that's floating around there, that Bitcoin has been heavily sold by all of the deep state and subterranean agencies and institutions, all the groups that Trump, he's cut their oxygen off. All these NGOs and the whole Democratic fundraising scam network, and there's so many, and this could extend all the way up to the CIA, but they all need money now because Trump has choked them off. And it is said that in this theory that's going around that not too far, you're not going to read about this in the New York Times, by the way, but the NGOs and the CIA have held digital wallets of Bitcoin since a time when only 14-year-olds knew what Bitcoin was. And of course, there's always been that suspicion that Bitcoin was a CIA operation. But if it doesn't get to that level, if they've simply held Bitcoin along with some of the Democratic slush fund machinery, that they needed to they needed to sell it to raise cash. So that's been what has that's a plausible reason, I think, for the pressure we've seen on Bitcoin. And at some point, they'll run out of Bitcoin to sell. But you could say that they transformed cold digital wallets, Bitcoin wallets, into hot ones, and that's what we've seen in Bitcoin's fairly stunning fall.
So Bitcoin, the preferred currency of drug dealers and the CIA.
Yeah, I mean it's hard to beat, really, if you're some shadowy organization that has an unsigned office in Belgium. It's a great way to move money, to move drug money, to move all kinds of money for secret or let's say hidden funding for certain organizations and operations. So it's a great medium for shadowy operations.
Do you think President Trump's 50-year mortgage plan is designed to keep people in their homes during tough economic times?
Well, Trump is doing so many things right, and his heart is really in this idea that in order to get America jump-started, we need to get young people engaged in the idea that they could actually buy a house and raise a family. And the 50-year mortgage was one way of getting at it, but I don't think it was a particularly good way to do it. If you kind of go through the steps, well, they have this vision of buying a house, and they think, well, I can get married and start a family, and we'll buy a house on a 50-year mortgage. But there's this problem, really, that I don't think Trump will be able to solve, or that has to do with jobs. You know, when you get that 50-year mortgage, even though you've got a lot of years to pay it, and maybe eventually move into a 30-year or a 15-year mortgage, the job comes first. You need to make your monthly payments on the 50-year mortgage, however low the payments are, and it would be, even though they can decrease the monthly payments with the long-term mortgage, they can't. It's going to be harder to decrease the cost of the house. So we're really looking at a very inflated housing market, but also a job market that to the 20 or 30-year-old must look pretty bleak at this point, and increasingly bleak because you can see that AI is going to heavily impact all jobs, really, except the trades. The plumbers and the roofing guys and the heating and air conditioning guys are all going to do fine, but it's time. It's time for some of the pain to be visited on the white collar job seekers, and they're really getting crushed, especially someone coming out of law school looking for that job, not a partnership, just a job that pays $50K a year with some, if that much, in some law firm where they're doing grunt work. Well, we can see that AI can handle almost all of the grunt work, and it can handle even. It can sit, and black box can sit there in the middle of a courtroom and handle a criminal prosecution or defense if it wants to, and that's something that the law partners haven't faced up to. But at the entry level, the jobs for accountants and coders and lawyers, they're getting killed. So you can't blame really young people for thinking. First of all, for voting commie. We're seeing this communist turn in certain places, cities, and that were already pretty red. New York being the primary example, but that's what happens when all the younger generation is looking out looking out 10, 20, 30 years ahead, and they see nothing. So Trump has come at it in certain ways, but I still think that his means are mismatched to the ends. He's not going to be able to create enough economic growth quickly enough to pay down what we owe. The debt levels are already crushing, and they'll become more so. Trump's taking the approach, well, we're just going to go deeper and hawk, but it will only be for a while before growth really gets cranking. But nobody, even Trump, I'm not sure whether he's thought it through, but when he talks about, and we've talked about this ourselves before, but when he talks about reshoring manufacturing, the only manufacturing that will be successful in this country is manufacturing that can compete with robotized, mechanized Chinese factories, so that however many factories Trump rejuvenates here, they're not going to require many workers. So, and when you take the long lead time for getting these things going, it's a stretch to think that Trump's big plan is going to work out. So I think he's doing great with so many things, just choking off woke and all its forms and essentially draining the swamp. He's doing a terrific job there, although, the gold standard there will be whether Hillary goes to jail, because her misdeeds, her felonies are probably the most boldly or clearly exposed. They've been written about for so long. But so Trump's doing a terrific job, and he's going at so many things in a way that's probably the only way we could do it. But with the economic stuff, I just can't see it working. And to promise affordability is definitely more than he can deliver. And so we're getting little things that he can brag about, like they just rejuvenated some steel factory, U.S. steel factory. It was already there. It hasn't even been repurposed. And, of course, the price of a couple of high-visibility prescription drugs has come down. But these are such little things in comparison to the big problem of no opportunities for younger people.
President Trump recently called the word affordability a con job by the Democrats. Is it?
No, I think he bears. It's really not a Democrat-Republican thing. They bear equal responsibility for the inflation that's caused everything to take off. And it's everywhere, really. And to brag about the price of this or that came back, and it came down a little in the last reporting period. Well, the big things that we all are weighed down by, the cost of health insurance, auto insurance, house insurance, the cost of homes, the cost of medical care. Those, how are we possibly going to make inroads? And even if you could revamp medicine, for instance, in a way that cuts out the insurers, and that's a big job. It's still a long road to bringing medical costs in general down to levels where doctors could again start opening private practices. But when the revolution comes and people start going to the guillotine, private equity guys are going to go first, because they're the well, I'm not going to use the word because I know you have a family show, but those jackasses are going to they're going to be marched right up to the blade. And it's really for the things that they've done, just buying all kinds of things that served us well, retailers and medical practices and things like that, and trying to squeeze every last dime out of them, and still worse, to leverage them with debt. And I think private equity is going to get its comeuppance for their huge move into speculative residential real estate. So if you're hoping that they get their just desserts, that's where it's going to come from.
Could President Trump's push to remove illegals from the country affect the price of real estate?
No. I mean, only in some localities, like that place in Colorado that had drug cartel members, thugs living there. But whatever the effect of removing illegals, I think it will have a minimal impact on real estate. I'm not sure that the stereotype is true that they're all living 12 to a room, but something like that situation obtains, and it's not like they're out there buying up all the suburban homes.
Rick, is there anything else that's really bothering you that we should keep a real close eye on?
Well, the stock market feels heavy. I did put out a commentary a couple of weeks ago that kind of jumped the gun and said, "Hey, this is a bear market," and it was really because of just an anxiety I got because the Nvidia, of course, took that huge leap on earnings that lasted for about 15 minutes, and it came down so hard and reversed so that it was in a net loss for the 24-hour period. And I thought, well, the AI bubble has finally been popped. And at the same time, Trump was somewhat under the gun and back on his heels, really, from all this Epstein stuff. And I do think that Trump's credibility and his success is kind of apexed. And so if Trump is on the downslope, and it's only relatively gentle at this point, but he's still under attack from all points of the compass, really. But with those couple of things happening simultaneously, I thought, well, there is the change in psychology that's going to start the market on a bear course. But I think I was a little, not a lot, but a little premature. I do still believe the stocks are in a topping process, but it's taking its time, and only on days like today, you could only say it's not so much a bear market as a certain heaviness in stocks. They're not making and holding on to the gains that they used to, that 6 months ago were easily achievable. And even their favorite, a couple of their favorite game meaning rigged fixed stocks, notably Microsoft and Apple, have been struggling. And the way that game has been played over really the entire course of the bull market, and it's created an enormous amount of fake wealth, is the gap up opening. And it's easiest to pull off this little criminal trick, just by waiting for earnings. Earnings instantly make stocks volatile, and that's when the shenanigans are at their worst. So what happens is a stock like Nvidia will close at the end of the day, and then earnings will be released, and it doesn't. You've seen that it really doesn't matter what the earnings are, how they can be horrific, they can be great, but stocks have only moved one way, so that they go up, and even if they go down initially, that's really just because the sleazeballs who rig the markets are shaking down these stocks to buy them before they run them up on short covering. So Nvidia closes at, and we're talking about a $5 trillion company. So, a 10% move in the stock, that adds a lot of fraudulent wealth effect to the world's books, to the macro ledger. So this has happened so many times that you could say, the generic sort of Bloomberg story would be that the stock market's, the bull market has created an enormous amount of wealth. But if you were to look at that claim under not even a microscope, all you need is a 2x magnifying glass, you'll see that most of that bull market, most of the movement has been in a form of short covering, and a lot of it with gaps where no stocks changed hands at all. So I can promise and guarantee you, and this really comes from the 12 years that I spent on a trading exchange floor, when the market's coming down and it hits all those gaps, they're nothing. They're insubstantial. The market's different stocks will crash those gaps, 2 or 3 at a time. And so we're going to come down a lot faster than we went up. And you could see the bear market that's coming be 60% over in a matter of maybe 3, 4, 5, 6 weeks. and then the grind to the eventual low could take several years. But that's really what I expect, and even though sometimes I get excited and think, well, they really did ring a bell at the top because of this reversal in NVIDIA or whatever. Well, we're not. Right now, you can look at the market and say, well, if there's a bell ringing, it's so faintly you can't really hear it. We just have a market that Friday. We expect things to be a little more exuberant, but the E-mini S&Ps are up just 6 points. And again, it was something I mentioned initially, that the chat room, Rick's Picks chat room, has really been hot because I had a target at 6907.50 and a quarter in the the E-mini S&Ps, and it came within 2 points of that, and the Qs came within, I think it was 17 cents of a target up there at 628 and change. So when things get violent and when they're topping, I get very accurate numbers for tops. I can't tell you whether these tops today are going to be the top or whether they're just a top, but the market feels so heavy right now that it's going to take more short squeezing than I can imagine to push it to new record highs. So I'd be, if not, I'd have 1 foot on the fire escape right now. And if you've made huge profits, as so many of my friends have in some of these, what I call the lunatic sector, the otherwise known as the Magnificent Seven, but so many of my friends have they've been in the lunatic sector up to their ears for the last couple of for years, and you get used to 20 and 30% gains every year on your portfolio, but I would be looking for the safety of cash and near cash instruments, treasury bills. I think the bonds still have a ways to fall. They've been under enormous strain because of Trump's propensity to want easing to get the U.S. out of its debt predicament. So yeah, be careful here.
Rick, how does one subscribe to Rick's Picks?
One need only go to rickackerman.com, and if you click on the free trial tab up top, you'll be there. But you're going to be amazed at what's going on in our chat room. It's just a great place to be if you're interested in. Someone posted a guy who really tracks silver. I mean, he goes out there in the fields with some of the executives of the mining companies. He's a pilot, an airline pilot. That's his day job. But he put out a note on a company called Cappy 10, and it was just $1.55 a couple days ago, and now it's $1.99. It traded, it looks like it's close to $1.99 target in just a few days, and you could have scooped it up for as little as $1.01 within the last week or two. So the silver stocks and the bullion stocks are finally getting hot, and there's so many great plays, but we've got some really knowledgeable people in the chat room about that, and there are even some Bitcoin guys who they may be philosophically on the other side of Bitcoin from me, but I don't mind forecasting higher prices if that's what the charts say. So anyway, rickackerman.com. Just click free trial and say hello when you get to the chat room.
Rick, thank you so much for being on This Week in Money.
And thanks for inviting me on, Jim. It's always a pleasure to connect with your audience.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Rick Ackerman. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.